this is not the only action that the Reserve Bank of India has done. If you take a look at what has happened since November of 2023 till now in March, you will realize that the RBI has been taking specific focused action on certain entities who have been bending the rules as far as the Reserve Bank of India is concerned. First, they started in November with how unsecured lending is handled in the Indian banking system. So for that, the Reserve Bank of India believed that there was some amount of over-exuberance and therefore they needed to increase the risk weights for unsecured loans. So that was the 16th of November. Coming a few weeks later, in the early parts of December, the Reserve Bank of India wrote to certain peer-to-peer lenders stating that the questionable practices that they've been following to extend loans to people, those need to be stopped immediately. This did not get notified. Of course, sources were telling this to NDTV Profit. Later in the month of December, on the 19th, the Reserve Bank of India came out with a specific set of guidelines against alternative investment funds. So what the RBI said is that banks which were lending to AIFs, who were in turn lending to any kind of a borrower of those banks, those kind of transactions needs to be stopped because that is essentially evergreening or round-tripping of funds. A few weeks later, again on the 31st of January, the Reserve Bank of India comes out with specific guidelines against Paytm Payments Bank. It says that Paytm Payments Bank has been under the RBI's review since March of 2022, and over the last 2 years, they've not actually addressed any of the issues that the RBI raised, and therefore there is a problem in how they are conducting their business. The RBI said that it will go ahead and stop all banking services being provided by Paytm Payments Bank. Following that, we had the 15th of February when RBI issued a letter to Visa and said that certain commercial card transactions, commercial credit card transactions that were happening in the economy were not kosher and they needed to be stopped. Come again a few weeks later on the 4th of March, where the RBI issued another press release talking about IIFL finance, where it said that there were issues with the way gold loans were being given out by IIFL finance. There were problems with the valuation of the gold. There was problems with the systems and processes that IIFL finance had, and therefore that business also needs to be stopped. Now, if you look at how this is panned out, now, of course, JM Financial, as you can see on the screen, similar kind of an action, stopping the shares and debentures lending business. If you see how the RBI is actually looking at all of these problems, typically in history, we've seen the RBI issue some kind of a penalty or levy some kind of a penalty on sector violators and then ask them to rectify those problems. Now, the RBI is saying, we will find the problems, we'll come to you and we'll tell you, you need to fix A, B, and C, and we'll give you a certain amount of time. If you're unable to fix that, fix those problems, or you're unwilling to act on the advisory of the Reserve Bank of India, then there will be some strict action taken against you. In these cases, we've seen business restrictions being put up on these sectors, on these companies. Broader action by the RBI seems to be that there is a need to take certain stricter measures, not just monetary penalty, but also business restrictions, because that's the only thing that hurts companies. And that's why people will go out and actually take the action that the RBI wants them to take. Now, let's take a look at what the RBI has been saying. The RBI governor in December, when in February, when there was a monetary policy announcement that was happening, the Reserve Bank of India governor was pointing out that they are taking action which is not knee-jerk in nature. In fact, this is a very reasoned action that they take against entities. This was just days after the RBI's action on Paytm Payments Bank. So the RBI governor said that we do not take these actions out of will. We are not doing this because we feel like it on one fine morning. We're doing it after a lot of discussion and negotiation with entities. I'll let you hear what the RBI governor said during that Monetary Policy Committee speech.
Our emphasis is always on bilateral engagement with the regulated entities, with focus on nudging them for corrective action. And sufficient time is given for undertaking such corrective action. The third point, when such constructive engagement which we undertake, when that does not work, so when such constructive engagement does not work, or when the regulated entity does not take effective action, we go for imposing supervisory or business restrictions. Number 4, such restrictions which we impose are always proportionate to the gravity of the situation. Please take note that such restrictions are proportionate to the gravity of the situation. Number 5, all our actions, being a responsible regulator, being a responsible supervisor, all our actions are in the best interest of systemic stability and protection of depositors or customers' interest.
All right, so that was the RBI governor explaining how the RBI decides on taking certain business restriction actions on entities which are violating its rules. Now, after that, just this week, veteran banker Uday Kotak, he also spoke about the regulatory guardrails and that excessive regulatory guardrails could impede economic growth. And he was speaking at an event organized by the National Financial Reporting Authority, and he said that there has to be a balance between the rule-making and law-making. Here's what he said.
If India has to grow, we must have, as an example of growth aspiration, not talking in the context of sector, but more sort of conceptually. If India has to grow, we need a lot more cars on the road, we need a lot more roads. But that has risks of accidents. So how do we ensure that accidents don't happen? One extreme way is to say, I will not allow as many cars on the road. I will not allow cars to drive more than 30 kilometers an hour or 40 kilometers an hour. And I will not build more roads. So I can manage a small system and I will have a better ability of controlling it. But that is at conflict with our growth aspiration. How do we manage both these levers? The answer is pretty simple. We must encourage a lot more traffic, a lot more roads, have better signals, better regulation, and most importantly, a fast resolution mechanism should an accident happen. I feel very, very optimistic for India's future. But I'm also very conscious that, and being a risk manager in my day life for a very long time, that unbridled focus on the opportunity without having the guardrails also runs the risk. And too much of guardrail will not get us there.
All right, so that was Uday Kotak, one of the foremost voices within the financial sector, talking about how if you want to control accidents, you can't really stop cars from driving on the road. Essentially, he's talking about where the financial sector is headed and whether there's a need for the regulator to be so strict with people who violate rules or who try innovation which is not really harming other people but may not be working with the regulators' point of view. Of course, apart from this, we also need to understand where people who are affected by these Reserve Bank of India directions, what they are feeling. So I have, is the RBI harsh? Now that's the question that IIFL Finance might be asking, and whether the practices of IIFL Finance are unethical. This is Nirmal Jain of IIFL Group, who took a conference call with the analysts where he's pointing out exactly how he sees the Reserve Bank of India's actions. Listen in.
While the directive of RBI appears to be a bit harsh, I take a moment to express our profound gratitude and admiration for the Reserve Bank of India. Their steadfast commitment to ensure stability and integrity of our financial system is unparalleled. With their proactive and prudent regulatory measures that have not only safeguarded the interests of all stakeholders and investors, but also contributed significantly to the nation's economic growth and stability. So the guidance and oversight provided by RBI are invaluable, fostering an environment of trust, transparency and resilience across the financial landscape. And we are grateful for their visionary leadership, unwavering support and guidance that inspire us to meet our challenges with determination and strive for excellence in all our endeavors. So we understand the concern that such news can generate amongst our stakeholders. However, I want to make it unequivocally clear that there are no governance or ethical issues at play. These are more operational and procedural issues, and which will address with all our efforts and sincerity. Our foundation remains solid, which is built on trust and support that all your stakeholders have generously extended over the years. And I also want to assure that we are taking immediate and comprehensive steps to address all the concerns raised by RBI. Our team is committed to implement the necessary remedial measures, not only to comply with the regulatory standards, but also to exceed them. So our resolve to rectify the situation is unwavering, and we are dedicated to navigate this situation or this challenge with transparency and integrity and utmost respect for compliance standards, regulations, and principles that have guided us.
All right, so that was Nirmal Jain, founder and promoter of IIFL Group. Of course, he's saying that there were no unethical issues at IIFL Finance and that whatever problems that the RBI found were operational in nature. We also had a chance to speak with Arun Kumar Purwar of IIFL Finance. He's on the board of the company, of course, on how long it will take the company to gain back the market share that it has lost since the RBI imposed these restrictions on the company's gold loan business. Listen into what Mr. Purwar had to say.
We are making efforts to ensure that we are able to convince RBI about our stance, about our compliance, and about our corrective measures which we have taken, and corrections which we have already done. Having said that, there is an advantage with our organization that in terms of IT, our organization can compete very, very effectively in the market. We have very good, sound IT systems in place. So once RBI lifts and permits us to start the business, I think it won't take much time for our organization to come back to business in a very fast manner and regain whatever market share we are losing today. I don't expect that any loss of market share would be there in 2025 or 2026. Our IT systems are so robust that we have an advantage with our competitors now.
That was Deepak Purwar talking about how exactly, I apologize, A.K. Purwar, who was talking about how exactly the IIFL Finance business will recover. We also spoke to Deepak Shenoy, founder of Capital Mind, a little earlier today, and let's listen into what he had to say about the regulator's action against JM Financial, which came last evening.
I don't think HNIs or even these guys have access to much, honestly, a lot more information, because otherwise they'll make money for themselves instead of giving it away to other people. But to be honest, one of the things that happens in these cases, it's a self-propagating thing, right? So you get one IPO to go 100x and every IPO wants to go 100x and so on. The problem here is not of retail investors. What I think the RBI is bridging, and I like that, is systemic leverage, which increases dramatically during an IPO and then fades away immediately after, because so if you look at, for instance, JM Financial and all that, they only reveal the results once a quarter. If they were doing weekly results for whatever reason, you would notice on these IPO weeks their balance sheet would increase dramatically and then come back down. This was done because they were thinking, we have the power of attorney to the underlying account. This money doesn't go anywhere. It is just kept in a bank account, and that bank account will be used only to fund the IPO and not for anything else. What if there is a court issue, there is something that happens with an IPO, SEBI stops the IPO, for instance, the money of the investors is stuck for 2 weeks. You have a problem. The leverage is so much, it was never intended to be given in the first place. It will not just affect the NBFC, it will affect everybody in the financial system.
Agreed.
People who have lent to the NBFC, the HNIs themselves, other stuff. So that's where the problem is, I think. Everything else seems to be a smokescreen. I may be wrong here.
Deepak Shenoy has been some strong views on how exactly IPO financing has been structured in India and why it's a problem and why the RBI may not be wrong in taking action against JM Financial. We'll take a quick break, and on the other side, we'll take the big story forward with some conversations that are ongoing on the topic with some financial sector experts. Thank you. Yeah. Hi, sir. Mr. Kumar? Mr. Kumar, hi. I can't hear him. Mr. Kumar, hi. Can you hear me? Mr. Kumar, hi. There's a problem. Mr. Kumar, hi.
Hello.
Hi, sir. Vishwanath here.
Yes, Vishnu.
Hi. We'll start in like half a minute. But
Okay.
essentially, point of the conversation is just to take us through what exactly the RBI is thinking in all these rules in all these restrictions that they put in. Just going to take that in slight more detail. So just let us know whatever your thoughts are. Yeah.
Okay.
Okay. Done. All right, welcome back to the big story. Of course, we're discussing the story about the Reserve Bank of India's actions against financial sector violators and how exactly the RBI has been taking strict actions against certain companies who've been bending or breaking rules that the RBI has set for the game. To discuss this topic further, I have with me Mr. Rajesh Kumar, a non-executive chairman of MasterCard India, chairman at BharatPe, and of course, former chairman of State Bank of India. Mr. Kumar, welcome to this conversation. Pleasure talking to you, sir.
Thank you. Thank you for inviting me on this discussion.
Mr. Kumar, I wanted to ask you this question. When you see the kind of statements that are coming from the Reserve Bank of India, NBFCs, Payments Bank, all of these entities facing severe restrictions on their businesses, how do you see this? In the past, we are used to seeing the RBI levy monetary penalties, but now it's coming more strongly against these kind of violations.
Yeah, no, the message is very clear that if there are rules, then those rules are to be followed. And what is their internal report or what has transpired before such action has been taken? So you and me are not privy to that.
Yeah.
But there is a presumption that when RBI inspection takes place or when they find that there is something which is not being done in accordance with the regulations they have laid out, then normally it is the practice that time is given to do the course correction. And if course correction is not done, then there can be monetary penalty, but there can be action more than levying any monetary penalty. Monetary penalty is a new phenomena which is just 4 or 5 years old. RBI did not have a system of levying monetary penalty. And RBI has very wide powers, let us admit it, when it comes to enforcing the regulations as far as the financial system is concerned.
Yeah. All right. Coming and looking at it from a broader lens now, back in November of last year, they started with unsecured loans. Then they went after AIFs. Since then, they've gone with P2P lenders who were acting out of order. They've gone after a card network that was supporting transactions which were not kosher. I'm speaking about actions that they've taken outside of these three entities which have come out in the last few weeks. Is it fair to say that these are probably the more vulnerable areas in the financial sector at this point in time, and the RBI is sort of plugging those stops before anything bad happens?
Yeah, obviously, one of the major responsibility which rests on the shoulders of Reserve Bank of India is the stability of the financial system, and if there is that a risk is building, then they would not like that situation to go out of proportion. And that is where the regulatory action is a preemptive action. When it comes to unsecured loans, for example, it's more of a preemptive action because the growth was much faster than the other type of loans or the system growth. So obviously, RBI feels that a risk is building in the system, and that's where they took certain steps.
Yeah.
Some are about like non-compliance issues. And so two are different. One is that anticipating that the risk may build in the system. So just not allow that to happen. Second is about that if we have laid down a rule or a regulation, you better comply with it.
Yeah. Yeah, got that. I want to ask you one more question before I let you go. But into your mind, when you put yourself in the shoes of the regulator, how exactly do you see the current system? Because the RBI has always maintained that the financial sector in India is safe, is stable. There is actually no imminent risk that may put that into question. Having said that, now there are violators that the RBI is identifying and specifically taking action against. How do you correlate these things if you were to put yourself in the shoes of the regulator?
Yeah, no, overall, there is no issue around the overall safety of the system. And banks were never in such a good shape as they are today. And that has been a very painful process through which the banking system has come out and reached a stage where we can say that our banks are safe. And similarly, these as a regulator, they have to be mindful of the impact which any other player in this system can cause a problem to this system.
Yeah.
So that's where, like, I think more attention is being to NBFCs and fintechs.
Yeah.
Because the oversight on banks is always more. And the number of players, say for example NBFCs, there are nearly approximately more than 9,500 NBFCs in the country. So regulating them all is not easy. So that is where scale-based regulation came in. Larger ones will receive more attention, and the regulatory arbitrage between the NBFC and bank is disappearing.
Yeah.
So I think the approach seems to be that take such action which has a demonstration impact. And if you take some action against, say, the bigger ones and take the action which is seemingly harsh, but that also sends out a message. And when everybody will start behaving. Okay.
I know I said the last question, but I want to ask you one more point. Is there a fear of spooking the market? Because these entities are listed, and if you take these kind of serious action restrictions on their businesses, does that sort of scare investors too much, even though this might be temporary in nature, technically speaking?
No, I think if for investor confidence, it's important that the players in the ecosystem, they are following the rules.
Yeah.
So short term, maybe. But ultimately, if the investors know that there is a strong regulatory oversight, then probably it will give more confidence to the investors rather than reduce it.
All right, Mr. Kumar, thank you so much for joining us on this conversation. As always, a pleasure talking to you. And thank you so much, viewers, for watching The Big Story on NTV Profit. Stay tuned.